Hi, welcome to Iron Financial. This is the channel where we don't just analyze stocks, we put them on the anvil and see if they break. I'm your lead analyst, and today, well, the forge is absolutely glowing hot because we are hammering on Microchip Technology. That's ticker MCHP. You know, their latest earnings report just dropped, and man, the headline numbers, they're creating some serious sparks. But our job, as always, is to figure out if what's underneath all that shine is solid steel or if it's just, fool's gold. So we're going to cut right through the smoke, we're going to stress test these fundamentals, and really see if this company's foundation can actually take the pressure. And I'm your market skeptic. He calls it solid, but I don't hear anybody cheering. I mean, come on. We got a beat on earnings, a beat on revenue, and this super rosy forecast. So you got to ask yourself, why did the stock stumble? Right? That lukewarm, almost cold reaction from the market. It tells me everything I need to know. It tells me the smart money, the big players, they are not buying the hype. They're popping the hood, and they really don't like what they see under there. So the only question that actually matters today, the one we're here to answer, is this. Is Microchip really building a fortress, or are they just setting a very expensive trap for the rest of us? Before we can even get into the bull or the bear case, we have to understand the battlefield. Let's just set the stage here for a second. The entire semiconductor industry, and that includes MCHP, has been weathering a really brutal storm. For the better part of their fiscal 2025, they were navigating what the company's own 10Q filing calls a large inventory correction. Now, this wasn't some minor headwind. This was a cyclical downturn that absolutely hammered the entire sector. Companies had too much product, their customers had too much product, and so, of course, new orders just dried up. That's the environment they are clawing their way out of. Exactly. And that is precisely why this report is so incredibly critical. This isn't just about Microchip. The entire street is watching MCHP as a bellwether, a canary in the coal mine, if you will. They want to know if the storm has finally passed for everyone. Is demand actually returning for real? Are we at a genuine turning point? Or is this whole thing just a dead cat bounce before another massive wave comes and hits us? The stakes could not be higher, which frankly makes all the conflicting signals in this report even more dangerous for investors who don't do the heavy lifting. All right, let's start by building the bull case. And I want to be very clear, this case isn't built on hope or hype or any of that fluff. It is forged from hard numbers and really clear operational momentum. The argument here is that Microchip has not only survived the storm, but is now emerging from it stronger, leaner, and with a very clear runway for growth. So let's walk through the evidence, piece by piece, starting right at the top line. So here's the first pillar of the bull case, and it's a big one. 15.6%. What is that? That's year-over-year revenue growth. Think about that. While the rest of the industry was basically treading water, trying not to drown, Microchip was accelerating. This is not a minor updraft, okay? This is a powerful signal that real, sustainable demand is snapping back into place. And let's be totally clear, that percentage, it translates into some very serious money. Just look at this chart we have here. Net sales jumped from just a little over $1 billion in the same quarter last year to nearly $1.2 billion this quarter. That's a $160 million increase. This is not a rounding error. It's not a small beat against some really depressed expectations. No. This is a significant structural improvement in the business, and it demonstrates that customers are finally back at the table, they're confident, and they are placing orders. This right here is the foundation of the whole recovery story. And they didn't just grow, they absolutely crushed expectations. Wall Street analysts, they set the bar at about $1.17 billion in revenue. Microchip just vaulted right over it. The street was expecting, 42 cents in earnings? Microchip delivered 44. Now, this isn't just about beating the numbers, it's a statement. It tells you that management has a really tight grip on their operations and that they're converting every single dollar of sales into profit much more efficiently than anyone, and I mean anyone, predicted. But here is where the bull case gets really compelling. It's not just about what they did. It's about what they're telling us they're going to do next. The market is a forward-looking machine, right? And management just gave it this massive number to chew on, $1.26 billion. That is the midpoint of their revenue guidance for the fourth quarter. It's a huge signal of accelerating momentum. They aren't just recovering, they're slamming their foot on the gas pedal. Yeah, let's really break down what that $1.26 billion guidance actually means. Sequentially, so quarter over quarter, it's a solid 6.2% jump. Pretty good. But now look at the year-over-year projection, a massive 29.8% growth. Let's just call it what it is, nearly 30%.
A management team, especially in this environment, does not guide that high unless they are supremely confident in their order book. They are literally putting their reputation on the line and screaming to the market that this recovery is the real deal.
And this quote, this just perfectly illustrates the entire bull narrative, and it's coming straight from the CEO. Steve Sangai isn't talking about getting lucky or, a rising tide lifting all boats. No, he's talking about a 9-point recovery plan. He's pointing to specific actions, to deliberate, calculated execution. The message is crystal clear. This turnaround isn't some happy accident. It's the direct result of a well-designed and, more importantly, a well-executed strategy. For the bulls, this is a textbook case of a strong management team navigating a tough cycle and coming out the other side stronger and ready to dominate. It's an incredibly compelling story.
A very compelling story. Yeah, almost too compelling, don't you think? If the story is this perfect, if the recovery is this strong, and the guidance is this bulletproof, then the stock should have gapped up 5, maybe even 10% on the news. But it didn't. It just fizzled. And that, my friend, is where the bear case begins. Because when a company lays out a perfect story and the market just yawns, it means the big money is looking past those shiny headlines and they're seeing cracks in the armor.
This is the one question that should keep every single bull awake at night. You can have the best spreadsheets in the world, the most optimistic quotes from the CEO, but at the end of the day, the price action tells the real story. And the story here is one of doubt. The initial reaction was a shrug, and then it became a dip. This implies that sophisticated investors, the ones who really matter, listened to that conference call, they read the press release, and they concluded that the risks just plain outweigh the rewards at this current price. They're selling into what everyone else is calling good news, and we absolutely need to understand why. So let's start with a number of our own, $18.5 million. I just want you to look at that number for a second. Before we even add any context, just think about what that represents. It's a very significant amount of money. And it's the timing of this particular number that raises the biggest red flag in this entire story. And here's that $18.5 million. That represents 255,000 shares of stock sold by the CEO, Steve Sangai, in January. We're talking just weeks before getting on a conference call to tell everyone how unbelievably fantastic the future looks. Now the bulls will scream, "Oh, it's a planned sale, it's for tax purposes." Fine, maybe. But the optics are absolutely terrible. If you're the captain of the ship, telling everyone you're sailing into a golden age, you don't start selling off pieces of the ship right before you leave port. It fundamentally undermines the entire public story. So the CEO's sale, that's the first big crack, but trust me, it's not the only one. Let's lay out all the pillars of the bear case. Number 1, the muted stock reaction we just talked about. The market is just not buying the hype. Number 2, the massive insider sale from the guy at the top. Number 3, a canyon-sized gap between their real GAAP earnings and their adjusted non-GAAP fantasy numbers they want you to look at. And number 4, valuation. At 30 times forward earnings, this stock is priced for absolute, utter perfection. There is zero room for error. These aren't minor concerns, people. These are major structural flaws in the bull thesis. Okay, those are valid points and they absolutely need to be addressed. I'm not going to deny that. A high valuation and insider selling are legitimate concerns for any investor. But we don't operate on optics here, we operate on data. The bear case points to cracks, so let's take our tools out and actually stress test them. We're going straight to the source, the company's official 10Q filing with the SEC. This is where we separate the fear from the financial facts. Let's really see if the foundation is as weak as the bears claim it is. Let's start with operational discipline. This is the heavy lifting that happens way behind the scenes, right? The stuff most people don't look at. Now take a look at this simplified balance sheet we've put together. If you go back to March 2025, right around the peak of that industry downturn, their inventories were just bloated. We're talking almost $1.3 billion of product just sitting there. Now fast forward to December, look what they did. They hammered that number down to $1.06 billion. That is nearly $250 million in inventory that they cleared off their books. That's cash, that's freed up capital, and at the same time, look over at long-term debt, it's down. Not by a little either. It dropped from $5.63 billion to $5.37 billion. So think about that. They are managing inventory and paying down debt at the same time. This isn't a company that's flailing around in distress. No way. This is a company that is executing a brutally disciplined operational plan. To me, that's the very definition of a solid foundation. Discipline is great, I'll give you that. But that discipline doesn't explain this chasm. Look at this. On a GAAP basis, and that's the generally accepted accounting principles, the official rules, the company's net income attributable to shareholders was just under $35 million. But then, in their press release, the big, shiny number they want you to focus on, the non-GAAP number, is over $252 million. That's a seven-fold difference. So what on earth are they excluding to make the picture look that much rosier? This isn't a crack in the armor, this is a canyon.
Okay, let's break down that canyon because it's a critical point, and you're right to bring it up. The vast majority of that huge difference comes from excluding two major non-cash expenses. The first is amortization of acquired intangibles, which is really just the accounting cost of writing down big past acquisitions over time. The second is share-based compensation. Now, it's pretty standard practice in the tech world to exclude these things to show what they call the underlying cash-generating power of the business. But standard practice doesn't make it right. That amortization charge isn't fake. It represents billions of real dollars they spent on acquisitions in the past. Excluding it is kind of like pretending that money was free. And share-based compensation is a very real cost to shareholders in the form of dilution. So, yeah, just because everybody does it doesn't mean it isn't a way to paint a much prettier picture than reality.
You're right to question the accounting, and we should always question it. But let's pivot for a second from backward-looking accounting charges to a really important forward-looking operational metric, one that can't be easily manipulated by these kinds of adjustments. I'm talking about the book-to-bill ratio. This is, hands down, one of the most important health indicators for any semiconductor company. It's actually very simple. It's the value of new orders they received, that's the book, divided by the amount they shipped and invoiced, that's the bill. Anything over 1.0 is a sign of strength. It means demand is growing faster than their current shipments can keep up with.
And Microchip's book-to-bill ratio was 1.07. This, right here, is the hard data point that directly contradicts the bare narrative of some kind of weak underlying demand. This isn't an accounting adjustment. It's not a quote from a CEO trying to spin things. It is a direct, unfiltered measure of actual customer orders. It proves that for every dollar of product going out the back door, $1.07 of new orders is coming in the front door. This is the clearest evidence we have that the demand recovery they're projecting in their guidance is not just a forecast, it's already showing up in their order book right now.
Okay, so we've laid out the bull case, which is built on a pretty solid foundation of strong revenue growth, very solid guidance, and key operational metrics like that book-to-bill ratio. And we've taken a hard look at the crux highlighted by the bears, that muted market reaction, the insider selling, the sky-high valuation, and that big gap to non-GAAP gap. So now it is time to weigh all of the evidence and deliver the iron financial verdict. Let's put it all on the scales. On the bull side, we have the foundation, 15.6% revenue growth, a blockbuster Q4 guidance, really disciplined debt and inventory reduction, and a solid 1.07 book-to-bill ratio that confirms future demand is real. And then on the bear side, we have the cracks, a stock that fell on what should have been good news, a CEO cashing out millions right before the report, a valuation that is stretched to the absolute breaking point, and an accounting gap you could drive a truck through. It's a pretty clear split.
So here it is, the iron financial verdict. The operational turnaround at Microchip is, without a doubt, real. The book-to-bill, the debt reduction, the revenue growth, the numbers prove that the company is executing with incredible discipline. The foundation is solid steel. But the market knows it. This valuation isn't pricing in a recovery anymore. It's pricing in absolute perfection, a flawless multi-year expansion with zero mistakes, zero hiccups. The insider selling, the market shrug, those are signals telling you that at this price, the margin for error has completely vanished. So the final word is this: you have a fundamentally strong company, but you do not have a bargain. The easy money has already been made. For new investors, this isn't necessarily a trap, but it is a high-wire act with no safety net. And the only question you have to ask yourself is this: are you buying a solid business at a price that leaves you totally vulnerable to the slightest crack?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.